I think, again, for some reason, like we haven't had that before in Germany, everybody is into this resi game again. And now with some support of the price developments in Berlin and the price developments in Munich, and so it's a lot easier to get a development loan for a residential development in a nice city in Germany. But I think there are still many areas of the market where you don't get development financing from traditional sources, but you have to find other debt providers.
Okay.
And the more, I mean, I don't know how, you probably, hotels at the moment is another topic where it's easier to get financing because it seems in Germany that a lot of market participants consider hotels as an asset class that is attractive at the moment. The same for logistics, retail developments, you do get financing if they're in the right location, if they're run by the right people. So it's a varied picture.
So partly that's to do with the relationship that you have with your bank.
And I think that the banks are just looking more closely at the business model behind the development. And let's say if you wanted, I mean, I don't know how familiar you are with the area, but if you went out today and you said you wanted to build an office tower in Offenbach across the river from here, or you wanted to build an office tower here in Frankfurt, you would have a completely different sort of lender landscape that would be willing to even consider giving financing for developments.
Okay, good.
So it's a very fragmented market.
From what we hear from our clients is that for the landmark residential deals, there was a lot more funding available than necessary. There was a fierce competition, and I think, I mean, every active financer in Germany wants to be part of the Deutsche Einigten refinancing. I mean, that's not a secret. Everybody wants to have a part of it, and we mentioned Beilaba before. They also, I mean, there was no problem getting the funds together on both sides, equity and debt, and so. Again, it's for the big names. They have the full choices. I mean, we have the German Pfandbriefbanks which lend to that. The Landesbanken. We have the pension funds. We see also this insurances coming with a former CMBS bank as fronter. And so I think at the moment a big residential company with a reasonable LTV has the full choice, and they play that competition very well, and so they squeeze margins, they squeeze documentation, and but it becomes more difficult when you're outside core locations, and you are not dealing with a core player with a strong sponsor behind that. In B locations, or let's call it more positive, core plus locations, LTVs reduce substantially. I mean, we just seen a portfolio which was partly in East Germany, Northern Germany, and they could not raise more than 50 LTV. And so, and even though a lot of banks were interested in that, but nobody would give a higher leverage on that. And so, it's polarized. The big ones, they could choose between all the new sources available. For B locations, smaller sponsors, smaller residential portfolios, it's a lot more difficult. And again, and what we also see, and you mentioned that before, I mean, a lot of funds are provided merely by extensions because, I mean, there's a deadlock scenario. Banks want to avoid insolvency, and at the end of the day, I mean, the banks are forced into 2 or 3 years longer, and then and wait and hope situation improves.